Welcome to the Meydan Podcast, where we discuss the innovative stories from leaders that are shaping the entrepreneurial landscape in Dubai. Today, we have the pleasure of having Malachi Halliday, the CEO and founder of Halliday Forfaiting Services. HFS is pioneering solutions that help bridge the cash flow gap in small businesses during their growth phase. Welcome, Malachi. It's so lovely to have you here today.
Thank you. It's an absolute pleasure. I've been looking forward to it.
So, Malachi, I wanted to start with a topic that I think anyone that's in the startup or SME space has experienced at one point, if not recurringly, during their growth phases, and that is managing cash flow and making savvy financial decisions as they start. Can you tell us a bit about what you have seen in the market? I know HFS has a lot of extensive experience helping MSMEs or SMEs manage the situation, and we'd love to get the insight from industry experts like yourself.
So we're funding a lot of early stage businesses across the UAE. We see a lot of founders having unrealistic expectations about how much cash they need just to get their business off the ground. In business, there's something called a J-curve, which in short is roughly how long it takes before you're cash flow positive and your business can kind of cover itself until you don't have to keep funding it yourself. A lot of businesses in the UAE, they'll underestimate the setup costs, not just of the license, but setting up their team, their office, and then after the initial costs, how long it takes them to generate their first revenues. Because if it takes them 6 months to iterate their product, really iron out their value proposition, 6 months to try and close a sale, and then another 2-3 months to deliver the job and collect on funds, it can be 9 months before first revenues come in. Yeah. So you're really looking at
and that's a good case scenario.
That's a good case scenario. So really you're looking at 12 months before they're generating solid cash flow. So 12 months of overheads plus the upfront costs. A lot of businesses, a lot of founders really don't budget for that.
I also see as well with a lot of startups, a lot of the times, or majority of the times, capital constraints are a big issue. And like you said, sometimes people don't really budget accordingly and don't realize how long it might actually take for a business to start generating a profit at the end of the day. In Dubai, there's a really nice streamlined process where, you get your license, you get your approvals, you can start working on it. And at Meydan Free Zone, the plan is to become operations ready from the second you go. And that's one of the reasons a partnership with HFS is so great, because you can support them in that journey. But for people that might not be too, let's say, savvy or haven't really explored that venture, it can really be a great result or a great reason for why a lot of startups fail within the first year or two of their establishment.
What you touched on specifically in Dubai, founders of these businesses don't appreciate with their sales cycle. I come from Australia. It's not like Australia where you entirely win on merits that are very public. Because a lot of the business community here is expat oriented, then a lot of the sales process is very trust based, which means for you to build that relationship with your clients, especially in the corporate space, whatever your usual sales cycle would be for your respective industry, it's a little bit longer. Again, especially for the UAE, collecting on those invoices, again, very relationship driven, but the time it takes for you to do the job, invoice the client, but then collect those revenues, it can be, on average, it's 2 months for B2B businesses.
And this mix of, diversity within the country is great and it provides a lot of opportunities. But with that, it comes with some challenges. And I'd love for you to tell us a little bit about the hurdles that you've seen over the past few years, especially, post-COVID. The entire world, not only the UAE, has really shifted in direction of how business is managed. And from a financial side and capital raising side, it's also been very, very different. In some cases, it's a pro, and for some people, it could be a con. Due to so many cultures and nationalities here, we're dealing with multi-currency transactions around the world. How are the challenges perceived from startups and SMEs and also from companies like HFS when it comes to any founder that decides to establish themselves in the UAE and now manage all of these added elements that maybe a few years ago we wouldn't have had to deal with?
I'll speak from the investor's perspective, and this goes for founders looking for any sort of money, debt, equity, or anything in between. From an investor's perspective, the first thing that we want to look at is the data and the availability of good data from that company. Now, in the UAE especially, tax and regulation, it's quite recent, a lot of the regulations that have come in. So the reporting standards and the governance standards, especially at the small business end, are not as high as a lot of the more developed economies where funding is more readily available. The impact of this for investors of all sorts is if we don't have the data to evaluate, we have to assume the worst. So this is one big challenge, specifically in the UAE from a funder's perspective. The next big issue, you mentioned COVID and the impact of that on businesses and especially access to funding. I've been here 15 years now, and we've had some boom and bust cycles. With every bust, unfortunately, a lot of businesses get hurt and there are a lot of downturns. Two things. One, the hit to their revenue that they collect. Over 10% of invoices don't ever get collected in this country, which is a huge shock to their cash flow. Which, of course, any funder, again, equity or debt or otherwise, we're all highly conscious of that. What's the sensitivity of these SMEs and micro enterprises to not getting paid, not being able to collect on their revenue? But that goes to the next step of, unfortunately, there are businesses here that don't succeed and they actually go out of business. So from a bank's perspective, and I'm quite sympathetic to the bank's challenge here, again, lots of expats here doing business. When you're funding expats, there's a higher flight risk. And a flight risk is where if you have lots of debts and you're maybe overwhelmed, you might try and leave the country to avoid that, which is never the right answer because these things follow you wherever you go. But unfortunately, that is what some founders do during the bust cycles. And that's something which makes it even harder for funders, especially banks, to support these SMEs. So COVID was a big turning point for that.
And that's why as well, funders need to do a lot of due diligence as well. And it comes down a lot of the times, the responsibility is on the founder or on the SME, because at the end of the day, like you were saying, a lot of receipts might not be collected. And so now we're missing a lot of key data points that at the end of the day could make the decision whether a bank or, investors decide to actually put in their money and support you at the end of the day. But that brings me to my next question. There's a lot of challenges, and this is on a worldwide level, when you're wanting to access bank funding. Can you tell us a bit about the difference between, if I was, let's say, an SME looking for either a loan or assistance in my venture, the difference it would be for me going and approaching a bank for that money or coming to HFS?
The first thing I say to any founder is, if you're looking for funding, look for the right sort of funding. So for a founder, if they're looking for a bank funding, I generally put this into the category of loans or asset-based financing in some mechanism that is lending against assets or the revenues of their business in general. Yeah. If you're going to a bank, you really should be looking at something that's a long-term investment that you're going to spend that money on. And banks, their diligence is highly focused on your balance sheet, what assets you have, the quality of your revenues, what they can take as security in case things don't go well.
And sometimes it can be a challenge to get their approvals because they're looking at all of these specific details. It's not like they're taking into account that you are still starting out. They're dealing with you as as an enterprise that owes us money.
It's unfortunately, it really is the case. On the one hand, this is the challenge of all investors, is on the one hand, we go out of business if we don't fund businesses. Mm-hmm. So every founder that comes in our door, and this is for any investor, we want to invest in them. That's the first instinct we have.
We can't also just chuck money at any idea that comes in.
Exactly. So that's a big challenge. The biggest difference between us and banks is banks are really lending against the balance sheet in the existing business. But we are believing in the founder, evaluating how they've gone with their product market fit, their revenues, and if they have good clients and good relationships with their clients, we'll fund them, which means we can fund businesses at much earlier stages than banks because our approach is fundamentally different.
And that actually leads me to my next point. I wanted to get HFS's perspective. When it comes down to funding, there's different streams. To my knowledge, I know there's like angel investors, you have your banks, maybe you have your friends and family that invest in your business venture. But I heard about invoice discounting, and I don't really know what that is about. And I'd love for you to explain to our audience, for those especially that maybe have never heard of the term or have never used it, what it actually is.
So invoice discounting is a type of trade finance. So of the three types, you've largely got debt and debt equivalents. You've got equity, which you mentioned, like angels or VCs, etc. And then you have trade finance. So trade finance covers all of your financing needs pre-serving a job, so maybe buying inventory or mobilizing funds for any sort of project activation through the project. So it can be invoice discounting against milestone payments, it can be order finance, etc., all the way to collecting those revenues. So it can be invoice discounting, factoring, forfeiting, or even revenue-based finance, especially if it's maybe it's a restaurant with a POS machine, or maybe it's a software with subscriptions. So invoice discounting is a type of trade finance, It's especially useful when you have a long cash conversion cycle. So a cash conversion cycle is how long it takes from when you first invest into a job to when you finally get the money back, your returns from that job. So if that's a longer time period, then you don't want debt, you don't want equity, you want very targeted trade finance. And invoice discounting is one example where we bring forward the revenues so you can start the next job sooner, or you don't need to invest as much into that job. So if you can do more jobs in the same year with the same amount of working capital, you make more revenue from a similar cost base. It significantly increases your profitability.
And I know HFS does actually use this method of funding. Can you maybe put it into contextual way? Let's say we have a new startup that started here in Meydan. They've gotten everything sorted. Their license is issued. They kind of know, or they really do know what direction they're going to go. How would they, if they came to HFS, use this sort of funding?
Absolutely. So we're especially useful for new companies that have established in Meydan, because let's say a company established within the last 2 years, they won't be able to get bank funding, angel investment might not be appropriate, but they can come to us after just the first few months of revenue. If they can show that they're getting paid on time, then they can say, Malachi, we have these invoices, our revenues are going well, can you fund us? And then we can fund them as a percentage of their invoices and their monthly revenue. We're really that first funding that comes in. And then following our funding, of course, is everything else we do for them.
And when that funding does come in, I'd love to hear any advice you have for the audience of strategies of managing that funding effectively, so that, because at this point, Dubai is very lucrative for a lot of people. Some people are very good and have very great financial literacy and keep to their books, might be quite frugal, but contrastingly, you have those people that, as soon as some money comes in, oh my goodness, I can buy these new computers, limited edition, this for my company, or even spend it on themselves. How would you go about, to any founder, no matter what stage of their company they're in, to manage those funds appropriately, effectively, and to actually use that to generate more revenue in the long term?
It's a great question. And this is something that we're incredibly passionate about, is not just funding companies, but help them scale with that funding. As you said, a lot of mistakes that are made are around what they do with the money. Often we see companies getting offices that are larger than what they really need. They build their team in such a way that there's a lot of underutilized capacity, man hours going to waste. So some of our first really important tips are, if you're bringing money into your company, make sure everything you have related to the sales process is really nailed down. So once you get that money, you're only paying for it for as long as you need to, so that you have the next orders lined up. Then after that, it would be make sure operationally you can really deliver on those jobs. The worst thing that we see founders do is, on the first point, spending on marketing when they shouldn't, because their product isn't refined yet. So they're selling a product, but the product at the early stages really should be selling itself. If you're not getting referrals, if you're not getting repeat business, then it doesn't matter how much money you raise, it's not going to cover the fact that your product isn't a great product.
And that would be like number one, as one of the main mistakes.
Number one, aim for product market fit as quickly as possible, and introduce anything other than equity only after product market fit. Until you have product market fit, just be using equity. Once you have product market fit, make sure the rest of your operations are really on point. Are you collecting your revenues on time? Number one. Number two, can you continue to deliver for these clients ongoing, so that when they do order more, or they order like a larger amount, you can deliver on that. So these are the things that we see founders miss opportunities and also lose existing business, which they've worked hard to win.
And at the end of the day as well, you have a lot of companies that will have very unique circumstances to them. You were mentioning about make sure that you're buying only what you're going to sell, or making sure that your sales team is up to standard and the product market fit is correct. But for example, with Meydan Free Zone, we have around 2,500 different business activities available to choose from. And then on top of that, we provide flexi desks with our license. So with how you were mentioning, people will invest in a bigger space than they actually need. Here, that is kind of removed. However, with the amount of activities that we have available, some situations will require people to, let's say for general trading, they might need to stockpile an amount of inventory that maybe in their mind they believe we're going to sell completely. But when it comes to crunch time, they have not been able to turn over, let's say, more than 30% of that inventory. In these kinds of cases, how do we crisis manage this, especially when you have funders, whether it's someone like HFS, whether it's someone like an independent angel investor, or even with a bank, because that can be really, really stressful. And decisions during that time can also break the entire business organization.
It's a really important question. And I should note, we get lots of companies applying with us that have reached this point. They're in a dire situation, and we don't fund those companies. For companies in this state of business, generally what we advise is first to focus on, number one, their revenues, make sure that they reduce their customer acquisition cost by upselling to existing clients. Whatever they can do to reduce their marketing spend is absolutely critical, but they still need to make that revenue. The next thing after that is, of course, their expenses, cutting their expenses where they can. So this is all before they come to a lender, and there's a reason for that. But cutting the unnecessary expenses, there's often a lot of waste. You mentioned buying lots of inventory or whatever it may be. This is not the time, if they're really tight on funds, to be buying in bulk in discount.
Maybe it should be the time for product testing, seeing what actually is selling and doing it in smaller quantities.
Absolutely, in smaller quantities, and making sure that they're getting clients ordering before they buy new inventory. But most importantly, they should not be getting debt from anyone if they're at this state of business. This is why I said they have to do the other 2 points first, focusing on revenue optimization and expense optimization and management. Because when they do come in to sort out their finances, if they have existing debts, they need to be transparent with their funders and then negotiate a solution so they can all come through this together. Because, of course, their funders, they don't want anything to go wrong as well. But at this state of business, they either need to dip into a rainy day fund or tap into maybe very friendly terms from angel investors. But really, it's equity at this point. They need to consolidate their business. It's an undefined amount of time before they sort of right the ship, as we say. And equity is the most appropriate sort of funding for this stage of business.
And one thing as well with forecasting, I think that's when it becomes absolutely critical, because of course you can't foresee any bull and bear situations in the future market, right? And you can't determine whether officially all of your inventory at one point is going to be sold, or maybe the timeline. But in this critical phase of a growing business, it's when you have to take all the decisions and make very, very wise ones from what results you get and then moving onwards, because it can determine as well who's going to eventually fund you if you do choose to use that option eventually. But that brings me on to my next question, is discussing the partnership about HFS with Meydan Free Zone. I'd love to hear what you hope that any people that come to get their license with Meydan can get out of using HFS's services, and the benefit that this partnership has, not only for Meydan's clients, but for people that, are interested in getting funding from HFS as well.
So first of all, we love Meydan Free Zone. And I'm not just saying that. We actually have our license through Meydan Free Zone. So that's already a step ahead for any companies applying. But what we do is, firstly, of course, we provide the capital for these businesses. And then we go to the next step, and then we guide them on scaling their business, managing their capital efficiency, and helping them raise additional funds. What we do with Meydan companies especially is we prioritize their applications. So we always have, a line of companies applying for funding. So we prioritize any companies that are applying from Meydan so they can access money sooner. Beyond that, we also provide specific relationship managers for every company that applies from Meydan Free Zone. They have their own relationship manager focused especially on their application, how it's going. And then post-funding, we provide them with their CFO to help address a lot of these issues, whether it be the governance and the data in their business, what KPIs they should be targeting so that they can access additional funding. We really support them through this whole journey up until they at least double their revenue within 12 months.
And that's great, because it's kind of twofold in a sense. Since you guys are established in Meydan Free Zone, you know the expectations and requirements internally already, because HFS had to go through it before you're even working with new people. And then secondly, at the end of the day, a lot of startups are in a situation where I call it the startup trap, because I fell into this years ago when I was running one of my startups. And it was that you end up having to manage every single area. You end up becoming your own micromanager. And if you have other people within your team, you micromanage everything. And finance is always an intense stressor for any business. And I would think at any level of growth, even full-blown corporations have to see where they can cut costs or manage their distributions at points. And at this point now, you just mentioned you get a CFO, which I think is incredible, because for a person that maybe is not good with finances but has to be wearing so much as a founder because of that, it is a lot of responsibility, and it takes away from them actually focusing on the actual value proposition their company brings. And they end up accidentally becoming their own financial managers. And they might not have any training or understanding, making poor decisions. And that could also backtrack their funding in the future if they ever need again. So I think that availability of providing a CFO and assisting them through their journey, even post-funding, gives that whole of a stable relationship and shows the commitment that HFS has to the clients as well.
Thank you. I appreciate that. And especially not just any CFO, but we're really aligned with these businesses. Because if you just get any old CFO, of course, CFOs do an amazing job for these companies, and on a fractional basis, even better. But because we are funding these companies, we have what's called skin in the game. We are determined that all of their growth is sustainable, healthy growth with good unit economics. And we're also focused as part of our job to make them more fundable. So we know from an investor's perspective exactly what all the different types of funders are looking for, whether it be to do with trade finance like invoice discounting or factoring, whether it be with equity like angels or VCs or venture builders, or even when it eventually comes to the stage of banks or asset financiers. This is what we deal with day in and day out. So it's that very targeted, specialized know-how that we bring to the table for all of the companies that we're funding and advising.
You guys have skin in the game. You don't want to lose your money. So there is a certain obligation that you want to be there as well. But what I do know from HFS is that although you guys are involved and want to assist through the journey, you're not the person that takes over. As we've seen with different VCs as well, even sometimes angel investors, they don't like the direction and decide to impose completely different directions for a founder. And I like that HFS has a very collaborative and supportive nature rather than an overpowering directional route with them. But you mentioned the discounting, the invoice discounting again, and I wanted to ask about, I heard you guys have a white labeling service that comes with the invoice discounting. How does that help? Why would we do a white labeling if someone is interested or curious about that?
Ultimately, our mission is to fund 2,000 companies across the UAE and to bring in over 100 million of foreign direct investment into the UAE. We love the UAE. We're going to spend our lives here, all of us in the team. And we want to support as many founders as we can. The reason we're excited about the white label opportunity is a lot of funders from outside the UAE, they're not familiar with the data environment here, the business environment, different risks that are here, currency risks, etc.
Completely different financial and legal requirements compared to other places in the world.
It's so exotic. And it's exciting, but it's also foreign. And that comes with risks that they're concerned about. So we offer them a full turnkey solution where it's everything from license to the team to customer origination, relationship management, credit evaluation, the whole solution so that they can enter the UAE, bring their funds from abroad, partnering with us. And again, we have skin in the game because we always co-invest. So that way we can attract capital from Australia, the UK, Singapore, etc. into the UAE. And it's a win for us, of course, because we can fund more companies. It's a win for our white label partners wanting to expand into the UAE and participate in this funding environment. And ultimately, and most importantly, it's a win for all the founders because it means we can fund more amazing businesses and great founders.
Any entrepreneur that's seeking funding for their business, I'd love if you could give us, your one tip of advice for any founder that is seeking to get some form of investment, no matter what stream, so that they can use it effectively in the long run, but also ensure that they secure it, because it is a very challenging and competitive market to enter.
If I had to only say one, and I'd love to spend 6 hours on this, but with just one, I would say that really know what sort of funding you're looking for, because depending on the type of funding, which should depend on what you're using it for, your type of investor will have different requirements. For example, if you're looking to spend on R&D or product definition, then maybe you should be getting equity because the timeline's uncertain, but you have a great potential future. If you're spending on machinery, maybe you should be very targeted on asset financing. When it's like that, they're just looking at the use case of that particular asset, so they don't look at the rest of your business so much. If you're looking at just some working capital to help you fund your invoices and to keep up with your growing business, then maybe you want trade finance. And with trade finance, all of us in the trade finance space, we're just looking at primarily what's the quality of your revenues, your relationship with your clients. We're not so concerned about you being a unicorn in the future. And we're also not concerned as much about how you use your machinery, but we are passionate about your revenue quality. So all of this comes back to, what are you looking to spend the money on? Look for the right sort of investor or funder for your business, and then reverse engineer. If you were that sort of investor, put yourself in their shoes. What do they most care about? Because depending on how they are funding you, that will affect the information that they want, the security that they want, the future that they want with you.
And with what you were saying, I really wanted to dive into a little bit of HFS's history, because if I'm not mistaken, you guys are the first company that is really funding businesses at their earliest stages of revenue. And in my mind, that comes with a lot of risk. It's very difficult to find people that will fund beneath 2 years and sometimes even a bit longer because of all the revenue records and data points that you had mentioned earlier. Can you tell us why you guys decided to invest in that kind of a business at that growth rate, and what you're hoping to get out of it with the intentions that HFS has?
At the end of the day, we're a business started by founders for founders. I started this business years ago as a founder, banging my head up against the wall, expecting to be able to access bank funding and not getting it, purely because my business just wasn't old enough. And I had great unit economics, great clients. And that really confused me and frustrated me at the time, because every metric of business depends on how you're growing. Are you growing profitably, and are you growing quickly? And if you can't access the funding to support your business, especially in the early days, that can immediately disqualify you from lots of funding channels in the future, whether that be VC or certain types of debt. As a founder-first business, we spent years trying to solve, how do we fund these businesses at this early stage before they really have a business? And I think this is one thing that sets us apart, is we are funding, and I say 2,000 businesses across the UAE, but we're really funding 2,000 founders, because at this stage of business, it's person to person. So much depends on the founder. If the founder is sick for 6 months, then there's no business. There's nothing you can evaluate about the business. They don't have financials at this stage.
It's like I was saying earlier, when you're a founder for a startup, you really are everything and anything within the company. You become the fixers. And so if they're out for 6 months, even the founder can't trust someone else to run it the way they foresee it. So it becomes such a problem.
Our approach, and we built it from the ground up, was in investing terms, we securitize their revenue because it's already post-delivery risk. But what that means from the founder's perspective is we're investing so long as they're approximately like cash flow break even, and because we also want to support businesses where we know our funding will help them. Because small problems become big problems when you introduce capital.
Yeah, and chucking money at something doesn't mean it's going to fix the situation.
Exactly. So we're super focused to fund as early as possible, but also when there's good quality revenues. So if they have good relationships with their clients, if they're demanding strong margins, if they have a product that really differentiates themselves, or they just have great relationships, then these are the businesses that we want to support, because they're adding a lot of value back into the economy, into the startup ecosystem, into the community in general.
I know HFS provides a lot of different solutions and assists businesses in different phases of their journey. Can you tell us of some success stories, maybe targeting one of the specific services that HFS provides? And maybe that will incentivize some of our viewers to, that's an issue that I've been having and I really want support in tackling this.
Generally speaking, all of our companies that we fund are doubling their revenue within 12 months, generally speaking. And often we have many examples where they actually double their revenue within 6 months and even sooner, because of the way our funding works, accelerating their revenue and their growth. A really sweet example of this is we supported a biofuels company. I can't say who their client was, but it was one of the major state-owned oil entities here. They were processing used oils and things like this, kind of toxic stuff, from McDonald's and KFC and other places like that, saving it from going to landfill, processing it into biofuel, selling it as green fuel to this oil major. When we funded them, they just won their big contract with the major client. They didn't have the funds available to them, and this one was just after the depths of COVID. So frankly, their financials were a mess. They couldn't get bank funding. We come in, and I don't want to say we saved the day, because at the end of it, it's the founder always.
Yeah, it's a collaborative effort.
It's collaborative, and the founder's always the hero of these stories. So we come in and we give the founder a helping hand just at this juncture when no one else would. They served that client and they won other big clients, and they've gone on to save 54 million kilograms of CO2 in equivalents since their incorporation. We're really thrilled by that because, of course, that now they've scaled. They're a huge company and they hope to maybe get a liquidity event, IPO perhaps one day, but also the social and environmental impact of that. Of course, we love all founders and we love to support them solving meaningful challenges. But this one with the biofuel, we've funded other companies like in waste management, in medical supply, in health and fitness. We especially love these companies that have a really nice positive social impact or environmental
There's a
impact.
level of corporate social responsibility that is also great to get out of it, especially if you can get it out of the funding. If two, things come out of it, then that's even better. But the hope is to get them to succeed, especially, like you said, there are phases where they have the vision, they have the drive, they have the connections, they know what they need to do, but they can't afford one piece of machinery that could maybe increase the amount of, let's say, production that they need to do to service a particular client. And if they can get support in just filling in that specific gap, then I think it can create wonders for so many companies. We have so many people around the world, and especially in the UAE, which is so driven by innovation, ambition, competition, that they bring their ideas, and a lot of them are brilliant, but unfortunately they might not be able to succeed after a few years, not even because they can't do it or the company can't do it, but because they don't have access to get the resources they need to fulfill orders or fulfill a commitment. And the fact that this company that you mentioned managed to close it, I think is so incredible. And I cannot believe they actually managed to reduce CO2 emissions by all of this production as well.
Yeah, it's really amazing. And I think in that particular example, our intervention was a 5-month intervention. We ended up funding them over about 3.5 million dirhams over that period. And their revenues, I think it was 250% or 300% increase in that time period. And then from there, it wasn't just the revenue that they made, but corporate clients then had the confidence in them to take them on as reliable suppliers at much bigger levels. So it supported their growth strategy, it supported their entire narrative, and we're immensely proud of that.
And to end off with today's conversation, I did want to get your opinion. We've talked about what maybe a funder will look for before they, invest in a company. But I'd love to hear, what would be your ideal founder to work with? Because we talk about ambition, we talk about drive and, a level of responsibility, but everyone is completely different. What would you say is the key thing that any founder should have if they not only want to get funding, but that is going to drive the funding into a success beyond what they're imagining for their business?
The number one thing that we look for in companies that we want to fund is, how is their product or service being received by their customers? Is this something where they have growing demand, that they have good margins on, and that they have great relationships with their customers? Because everything in their business, as a trade finance provider, everything in their business flows on from that. Their collections flows on from that, their profitability, their growth, so that we can increase funding with them, and of course the funding that we then raise for them after. So the number one thing that we look for is their relationship with their clients and the value that they're providing to their clients.
And just to end off with today's conversation, I wanted to get your insights on what is in the future for HFS. Are you planning to scale and maybe provide funding for completely different types of companies, not just SMEs that are still in the beginning phases of growing their revenue? What can people look forward to in the future?
Absolutely. We're extremely excited for the next 15, 20 years of what HFS can provide to the startup and microenterprise ecosystems. We're not looking to necessarily encroach upon other funders' niches. We're a big believer in knowing what you do and doing it very, very well. And we are the best in the UAE in our funding model for early stage businesses. What we do want to do is work with more funding providers across the UAE, because after we funded these early stage businesses, we then raise more money for them. So we want to collaborate with more and more and more larger funders, ecosystems, amazing groups like Meydan as well, and ultimately attract a huge amount of capital from overseas into the UAE. All in support of funding more amazing founders on incredible journeys, offering great value.
So glad that you took the time to speak with me today. It's great to hear that there are actually people around the world that are fighting to remove financial barriers, especially for people that are driven and wanting to establish a brilliant idea. I mean, there are people that today might have the cure for an incurable today disease, but they can't even access the funding because there's a lot of risk and there might be a lot of skepticism. But I think HFS's work is actually paving the way for more funders and investors to look at businesses differently, not just see them as a risk rating, but rather see them as people with meaningful ideas that could actually improve humanity and improve the world. So thank you so much. This was such a lovely conversation.
It's been an absolute pleasure. Thank you for having me.
To our listeners, thank you so much for joining me today on the Meydan Podcast. We hope you gained invaluable insights from the funding world and managed to see that there's so many opportunities that you can get, not only in Dubai, but from HFS. Until next time, I hope you join me to listen to more stories from the groundbreakers and innovators that are changing the Dubai business landscape.